Here today to hear my spotlight. As you will find out shortly, I recorded this video prior, and it says that I'm in New Jersey, but I'm not. I'm actually in Italy, and I would be here with you today, but the time zone is just way too different. It's 3 in the morning right now. So I want again to just thank you for all being here, and unfortunately, I'm going to Italy not for a happy reason. My uncle has passed away. So I was going to go there to say my goodbyes, but I didn't make it. So I'm going to be with the family and I'm going to go for the funeral. It just reiterates the importance of life insurance and long-term care insurance. If you recall, my grandmother passed away in April. She was 110 years old, so she would have destroyed a long-term care company if she had a long-term care policy. But she didn't. I don't know if that even exists in Italy. And then my uncle, if he would have had a life insurance policy with a long-term care rider, he wouldn't have needed the long-term care because it went really fast when they put him into the hospital to when he passed away, cancer. If he had a life insurance policy with a long-term care rider, if he lived a long time and needed care, he would have had that long-term care benefit. But in his case, he didn't need it, so he would have had a life insurance benefit for his family. So please think about this. Pass this along to all your friends and family. It is so important to protect the ones you love. And here we go. My presentation shall begin right now.
Hello, everybody. This is Melissa Levin from Melissa Levin Insurance Services, and I'm coming to you today from New Jersey. I am going to be talking to you today about how I kind of fell into the path of life, disability, and long-term care insurance in my financial planning life. So in 1997, I graduated from UC Irvine as a math statistics major. So being a math major tells you that I love numbers. I love to do the analysis. I love to figure out things, solve problems, come up with something better. Then in 97, I started on my path in financial planning. And through that path, I found that I loved helping people look at their entire picture and make sure they're protected in the areas of life, disability, and long-term care insurance, because they are a very, very important part of your financial planning process, and they can destroy someone's plan. So I'm not going to talk about everything today. I'm just going to talk about a few specific things. I'm going to talk about, should you look at a permanent insurance policy as part of your retirement plan, and why should you? And then if I have time left, I'm going to give you some recommendations or show you some of the things that I've done as far as why you should review your life insurance policies. So let me share my screen. Okay, the first thing I'm going to talk about is sequence of returns. So if you look over here, I know this is very small. Let me make it bigger. Okay, if you look over here, here's someone age 41, and we look at a hypothetical situation, $1 million put in there at age 40 actually, and there's no additions, there's no withdrawals being put in. And so all of the way we look at this, this person gets a 7% return over a 25-year time period. However, the sequence of return in each of these lines here is completely different. So the cool thing about this is, though, that even though there was a different sequence of returns at age 65, the portfolio had the same exact value, even though it was going in different places during the whole thing. So I'm gonna share this with you. So here's Mrs. Jones, here's Mr. Smith, and here's Mr. Brown. So this is after 1 year. So Mrs. Jones started having a positive return in our market, 22%, 15%, 12%, and then we had down market, -4, -7, up 22, etc. Mr. Smith started with a down market, down 7, down 4, up 12, up 15, up 22, down 7. And then Mr. Brown, in this completely fake world, because this doesn't happen in the world we live in, Mr. Brown had 7% every single year all the way through. And if we scroll down to the bottom, what we see here is that no matter what, the average return on all of these were 7%. And so they all ended up with $5,434 and $5,434,372 at the end. So it didn't matter how they got there. So this is just showing it in in a chart. So it doesn't matter what happens, how they got there, but on average, they all got a 7% rate of return. So they all ended up in the same place. So one of the biggest risks in retirement is that when you retire, you fall into the category of Mrs. Jones. Not Mrs. Jones, that's a great category. You fall into the category of Mr. Smith. So in this scenario, let's say that they now retire at 65 and then they get these same returns. So Mr. Smith just went down 7% and he's taken income out. Then the next year he's down again, down 4%, and he's taken income out. That can have an extremely negative effect on your portfolio. So here is where and when life insurance can be very beneficial to use as a strategy in your retirement plan. So I want to state, though, it's not for everyone. Not everybody should be doing this. I look at everybody's situation, and everybody's situation is different. And when I find the fit, then it's great. But you never, ever want to get into something that's not appropriate for you. So I'm going to give you this example. This is Tom. He bought a life insurance policy with keeping in mind that he wanted to use this as a retirement vehicle. So that was his main goal. Yes, there's a death benefit upon it, but that's not what he was concerned about. He wanted a place that he could diversify in, different from his 401ks, different from his IRAs. So I'm not going to tell you all of the benefits of doing this. I'm just going to talk about one benefit here. And if anyone's interested, we can go into detail more for your personal situation. But here's the beginning balance at age 65, and he is $1 million. He's taken out $70,000 a year. So after his withdrawal of $70,000, he has $930,000. However, the market was down 14.66%. This is what I'm talking about. This is the risk. The market's down. This is real. I mean, this is not some crazy number. So he has a year-end balance of $793,662. So he had bought this life insurance policy. It has a death benefit of $500,000, and in the end, he's got cash value of $233,000. So he bought this a while back. Now, okay, so the first year we had a down market. So when you have a life insurance policy that you can use in conjunction with your retirement accounts, what happens in that next year when he's 66 is you stop taking money from your retirement account. So this is why it's black right here. What you're saying is, I need to have a positive year, and then I'm going to start taking money from my retirement account again. So he moves over into the life insurance bucket, and he pulls out only $50,000. And why only $50,000? Because when you pull out money from a life insurance policy in the correct way, you pay no tax on there. So over on the $70,000 side, on that, when he pulls that out, he has to pay 100% tax on there. So therefore, we're able to pull out less money and still have the same, equate to the same dollar amount. So he pulls out $50,000. His death benefit is reduced by that, and he has $195,000 left in cash value. Okay, so we go back over to this side. We have another down year of 26%. So again, he doesn't pull from there. Takes out another $50,000 from here. He's got $155,000 left. Now we have an up year, up $37,000. So then he starts taking it. And by the way, this is increasing for inflation over here. So he takes out $72,000. So you get the drift here. I'm not going to go through every single number. So you pull out from the life insurance policy if you've had a bad year, and you let your retirement accounts, you let them come back. You give them time to come back and not pull out money to make it worse. So what do we have? If we do that, we have $3,587,396 left in his portfolio. And what I wanted to share with you was, what if we didn't take out from both of the sides? If we just took out those same markets, we just took it out from your regular retirement account, and you did not have a life insurance policy. At the end, he would have only $444,791 left. So, and why? And it's because you didn't give your accounts time to recover from that down market. The life insurance policies also have a feature in there that if the market is down, you have a 0% floor. So again, that's getting into a lot of information, but again, over here, there's $86,000 left. If he happens to pass, there's a $213,000 death benefit. plus this $3 million that he has in the retirement. So this is why you would want to use a life insurance policy in conjunction with your regular retirement accounts. You've always heard, don't put all your eggs in one basket. Okay, so if anyone wants to hear any more specific detailed information about this or go over this more in detail, maybe you have, you want to help me get some clients that may be good for this, or at least open up the discussion to see if they are the right fit. But one thing I'll tell you is I will never put someone in anything that is not what is the best fit for them. Okay, so I want to give you a real life example of someone who came to me. They had a life insurance policy, and usually what I hear from people is, you can't help me. I got this policy so long ago, there's no way you can help me. And I said, just let me look. You never know. A lot of people don't understand how life insurance policies work, and so they just assume that since they bought it a long time ago, that they can't be better because they're older. So this is someone that came to me. They had a $400,000 universal life policy, and when I order what's called an in-force illustration, I can really see what's happening with these policies. So when I ran this illustration and looked at it, this policy was set to lapse, meaning it's not going to exist anymore at age 74. And this client had no idea that this was the case. They thought you buy a permanent policy, it's here forever. So what I did was I was able to get him a different type of policy. I was able to guarantee that no matter what, it's going to last until age 88. So that in itself is great. I was able to increase the death benefit to $431,645. Or option number 2 would be to get that same type of policy guaranteed to age 90, but have a long-term care rider on there. And what the trade-off is the death benefit gets reduced to $393,000. So it's obviously a way better policy. He had $400,000 and it was going to lapse at age 74. So I was either able to increase his death benefit with a guarantee that it won't lapse until a certain age, or I was able to put a long-term care rider in there, which is really, really important in your retirement plans. Okay, let me pull up my other example. Okay, here's someone, he needs $2 million of life insurance. So currently he has a $500,000 30-year term, and there's about 20 years left on it, paying about $81 a month. And he has a $200,000 universal life policy with a $100,000 rider on his wife and $200,000 on his children. And this is going to lapse at age 82. So what I recommended to him, keep the universal life policy because Shauna and the children are on there. Those don't exist anymore. So I said, don't touch that. That's a great one. But what you want to do is replace your term policy and get a new one that would be $58 a month, and it's a 20-year term. So basically you have the same term period, but you're paying a lot less money. So I'm not going to go through all of this here with you, but that's just the gist of it. This is showing that even if you have a term policy and you bought it a long time ago, the cost of insurance has gone down over the years. So don't let it stop you to just do a free review. I offer a free analysis, a free review to anyone that has life insurance to see if I can improve. And if I can't, then they walk away knowing that they have the best thing out there for them. I hope you enjoyed my presentation today. I miss you all. I will see you next week. And remember, get insurance so you don't need to think should something happen to you in a blink. Take care.